Have you ever felt like everyone around you just gets money and you're just nodding along pretending to keep up? That anxiety about not understanding stocks and investing? Not your fault. The stock market isn't actually complicated, it's just been explained badly, on purpose. So today, we're fixing that. What stocks actually are. Let's start from zero. Forget everything you think you know. Imagine Sarah starts a bakery. She invests $50,000 of her own money. She owns 100% of Sarah's Bakery, Inc. Now here's how ownership works. She creates 100,000 shares of stock. She owns all 100,000 shares. Each share represents 0.001% ownership. Think of shares like pizza slices. The whole pizza is the company, each slice is a share. Year one, the bakery does well. It's now worth $200,000 based on revenue, assets, and future potential. Sarah still owns 100,000 shares, but now each share is worth $2. That's $200,000 divided by 100,000 shares. Her net worth from the bakery? $200,000. Stay with me because this is where value comes in. She wants to expand, maybe open a second location, buy better equipment, hire more staff. But she needs $100,000 to make it happen. Now she's got three ways to get that money, and this is crucial because it shows you how companies actually think about financing. Option one, take a loan. That's debt, she has to pay it back with interest. Option two, use profits. That's slow and limits growth. Option three, sell ownership. That's equity. No loan to repay, no interest payments, but she's diluting her ownership. Sarah picks option three. And here's exactly how it works. The company is valued at $400,000. Sarah decides to sell 25% to investors. She creates 25,000 new shares. That's 25% of the company. New total shares, 125,000. Price per share, 400,000 divided by 125,000 equals $3.20 per share. Sarah gets $100,000 cash for expansion. Now, Sarah owns 100,000 of 125,000 shares. That's 80% ownership. Investors own 25,000 of 125,000 shares. That's 20% ownership. This is equity financing in its purest form. The investors gave Sarah money. In return, they got ownership. The company doesn't owe them anything back. If the bakery fails, they lose everything they invested. That's the risk. And when you buy stock, whether it's Apple or Tesla or random company, this is what you're buying. You're buying a slice of that pizza. You're becoming a partial owner of a business. Not a loan to the company, not a donation. Ownership, an actual stake in whether that business succeeds or fails. That's what a stock is. And everything else we're going to talk about builds from this foundation. Private versus public companies. Private companies. Right now, Sarah's Bakery is what we call a private company, and this distinction actually matters a lot. Being private means a few specific things. First, there's a limited number of shareholders, usually under 500 people. These are typically founders, early employees, maybe some angel investors or venture capitalists. Shares not available to the general public. No obligation to disclose financials publicly. But for most companies that grow to a certain size, there comes a moment when going public starts to make sense. Fast forward 10 years and Sarah's Bakery has grown massively. She's absolutely crushed it. We're talking 50 locations across multiple states, $10 million in annual revenue, $2 million in profit. The company's been valued privately at $50 million. And now Sarah's at a crossroads. She could stay private, keep doing what she's doing, maintain control, avoid the scrutiny, or she could take the company public. So why would she choose to go public? What's the upside that makes all the complexity worth it? Here are the big reasons companies make this leap. Raise massive capital for expansion. Provide liquidity for early investors and employees. Increase company prestige and visibility. Use stock to acquire other companies. Compensate employees with stock options. Sarah weighs all this and decides, let's go public. Let's do an IPO, an initial public offering. But here's the thing, it's not like flipping a switch. This is a massive, complex process. The 6 steps to going public. Step 1. Hire the gatekeepers. 6 to 12 months before the IPO, Sarah needs to hire investment banks. We're talking Goldman Sachs, Morgan Stanley, JP Morgan, the big players. These banks are called underwriters, and they're going to manage this entire circus. They'll price the offering, find buyers, handle the regulations, coordinate everything. But they're not cheap. They typically charge 4 to 7% of the total money raised. If Sarah raises $50 million, that's $2 to $3.5 million in fees. That's the cost of entry. Step 2. The paperwork nightmare. 3 to 4 months of intense work goes into what's called the S-1 filing, the registration statement with the SEC. This document is everything, and I mean everything. Financials going back years, every risk factor, and I mean every possible thing that could go wrong. Business model, competition, management bios, how they plan to use the money. The SEC reviews this for 30-plus days, comes back with questions, demands clarifications. It's a back-and-forth process. And here's what's wild. Once it's filed, it's public. Anyone can go to sec.gov and read the entire thing. All your numbers, all your strategies, all your risks, out in the open. This is the trade-off. You want public capital, you give up privacy. Step 3. The roadshow. This is where it gets interesting. 2 to 3 weeks of back-to-back presentations. Sarah and her executive team basically go on tour. They're meeting with institutional investors, the big pension funds, mutual funds, hedge funds, the players who can write $10 million checks. They're presenting the company vision, walking through the financials, explaining the growth plan, answering tough questions, and the underwriters are watching carefully. They're gauging investor interest. How excited are people? How much demand is there? This feedback determines the price range. It's part pitch, part negotiation, part market research. Step 4. The night before. The night before the IPO, everything comes together. This is pricing night. Based on all that investor feedback from the roadshow, the underwriters and Sarah's team sit down and agree on a price. Let's say they decide $20 per share. They're offering 2.5 million shares to the public. Do the math, that's $50 million raised minus those hefty fees we talked about. This number, $20, is crucial. Price it too high, the stock could flop on day one. Price it too low, you're leaving money on the table and signaling that you undervalued your own company. It's an art as much as a science. Step 6. Opening bell. The next morning, Sarah's Bakery starts trading on the NYSE or NASDAQ. Let's say the ticker symbol is BAK. The IPO price was $20, but here's where it gets wild. Once the market opens, the price is determined by pure supply and demand. And more often than not, there's a pop. The stock jumps on day one. 20, 30, sometimes 50% gains are common for hot IPOs. Let's say BAK opens at $20, and by the end of the day, it closes at $28. That's a 40% gain in a single day. The market cap is now $70 million. Those early investors who got in at the $20 IPO price just made 40% in one day. That's the IPO pop everyone chases. But here's the twist. Sarah and the company don't get that extra $8 per share. They raised money at $20. Everything above that goes to the investors who got in early. This is why pricing is so critical. If you underprice by too much, you're essentially giving away money to early IPO buyers instead of raising it for your company. Step 7. The new reality. So, the IPO is done, the stock is trading, Sarah is rich, right? Well, yes and no. Her ownership has probably been diluted down to 30 to 50% by now, between the IPO shares and previous funding rounds. But 30% of a $70 million company is $21 million. That's significant wealth on paper. Wait, you might be thinking, didn't she have 80% of a $50 million company before? That was $40 million. She went down? Well, not quite. That 70 million is the market cap now, day one. Before the IPO, the 50 million was a private valuation, probably from her last funding round. It's not as liquid, not as reliable. Plus, the company will keep growing. That 70 million could become 200 million, 500 million, who knows? And now Sarah can actually sell some shares if she wants liquidity. She's not locked in anymore. But here's what she gave up: privacy and peace. She's now a public figure. Quarterly earnings calls where analysts grill her on every number, SEC filings for every major decision. If the company misses expectations by even 2%, the stock could tank 15% in a day. The stock price becomes her report card, updated every second the market is open. Employee morale gets tied to the stock. Investors expect growth every quarter. Going public is powerful. It unlocks capital and opportunity. But it also means living in a fishbowl. Every move scrutinized, every quarter measured. And that's the trade-off every founder has to consider when deciding whether to take their company public. How stock prices are actually set. The auction system. Okay, so we've covered what stocks are and how companies go public. Now let's talk about the thing that confuses everyone. How do stock prices actually get set? This is simpler than you think. At its core, every single stock trade requires just two things: a buyer willing to pay X and a seller willing to accept X. When you're willing to pay what I'm willing to accept, the trade happens. It's literally an auction, like eBay, but happening thousands of times per second. But let me show you how this actually works in real time. Let's say you want to buy Apple stock right now. You pull up your brokerage app and you see a price, let's say $195.45. But that's not the full picture. Behind that single number, there's something called an order book, and this is where all the action happens. Picture it like this. On one side, you have people who want to sell. On the other side, you have people who want to buy. They're all listing their prices, waiting for a match. The sell side might look like this: 100 shares available at $195.50. 500 shares available at $195.48. 1,000 shares available at $195.45. The buy side might look like this: 200 shares wanted at $195.40. 800 shares wanted at $195.38. 1,500 shares wanted at $195.35. Now notice the gap here. The highest anyone's willing to pay is $195.40. The lowest anyone's willing to sell for is $195.45. This gap has a name: the spread. In this case, it's 5 cents. The highest buy offer, $195.40, is called the bid. The lowest sell offer, $195.45, is called the ask. And here's the thing: no trade can happen until someone crosses that spread. Either a buyer needs to come up to $195.45, or a seller needs to come down to $195.40. So you want to buy 100 shares of Apple. You have a few options, and understanding these is crucial. You have choices. Market order: you pay $195.45. You accept the lowest ask price. Happens instantly.
Limit order at $195.40. You wait, hoping the price drops to match your bid. Limit order at $195.50. This executes instantly because you're offering more than the lowest ask. The seller at $195.45 will gladly take your $195.50 offer. You overpaid by 5 cents per share, but you guaranteed you got in. See how this works? It's all negotiation, all supply and demand, all people deciding what they're willing to accept. Here's where it gets really interesting. Let's look at two scenarios that show you exactly how prices jump or crash. Scenario 1. Good earnings announced. 10,000 investors want to buy immediately. They place market orders. First, they buy up all shares at $195.45. Gone. Then $195.48. Gone. Then $195.35. Gone. The next available seller wants $196. The stock jumps to $196. New buyers now have to pay $196 or more. Price rises until buying and selling equalize. Scenario 2. Scandal announced. 10,000 investors want to sell immediately. They place market orders. First, they sell all shares to buyers at $195.40. Gone. Then $195.38. Gone. Then $195.35. Gone. The stock has just dropped from $195.45 to $194.50 in seconds, and that becomes the new price. More sellers pile in at $194, $193, $192, trying to get out before it falls further. The price keeps falling until the selling pressure exhausts itself and buyers see enough value to step back in. Price falls until buying and selling equalize. Here's what you need to understand. The price at any given moment is simply the price of the last trade that happened. It's just supply and demand, an endless auction happening in real time. There's no conspiracy, no manipulation, well, mostly. We'll get to market makers later. No hidden formula. It's thousands of people making thousands of individual decisions every second. Is this stock worth buying at this price, or should I sell at this price? And those collective decisions, millions of them per day, determine what we call the stock price. It sounds chaotic, and honestly, it kind of is. But it's also the most efficient price discovery mechanism humans have ever created, because at any given moment, the current price reflects the collective wisdom, or panic, or greed, or fear of everyone participating in the market. And once you understand that, you start to see stock prices differently, not as some objective truth handed down from on high, but as a constantly shifting consensus, a real-time vote on what something is worth, which means the price can be wrong, massively wrong sometimes. But we'll get into that later. So we just talked about how stock prices are set through supply and demand, buyers and sellers matching up in this constant auction. But there's a problem with that system, a big one, and most people never think about it until it's too late. What happens if you want to sell your shares and nobody wants to buy them? Or flip it, what if you want to buy but there are no sellers? Enter the market makers. These are specialized firms whose entire job is to make sure there's always someone on the other side of your trade, always a buyer when you want to sell, always a seller when you want to buy. Let's go back to Apple trading around $195. Market maker bids $195.40. Asks $195.45. You sell to them at $195.40. Someone else buys from them at $195.45. They pocket 5 cents per share. Not much, right? But here's the thing. They're doing this millions of times per day, across thousands of stocks. 5 cents here, 10 cents there, 3 cents over here. It adds up fast. And unlike regular investors who might make 1 or 2 trades a day, market makers are executing thousands of trades per second. The volume is insane. Imagine trying to trade stocks without market makers. What would that actually look like? First, small stocks would be nearly impossible to trade. Second, you'd waste enormous amounts of time. Third, prices would be wildly volatile. Market makers smooth this out by always being there with a price. Look, I know middleman sounds like a bad word. We're taught that cutting out the middleman saves money, right? But in the stock market, market makers are middlemen who actually earn their keep. They take on risk, holding inventory of stocks that might drop in value before they can sell them. They provide instant execution, so you don't have to wait around, and they stabilize prices by always being present with buy and sell orders. Yes, they profit from the spread. Yes, they're making billions. But the alternative, a market without them, would be so much worse, slower, less efficient, more expensive in terms of time and opportunity cost. They're like the logistics companies of the stock market. Amazon couldn't exist without UPS and FedEx.
The stock market couldn't function at this scale without Citadel and Virtu. You might never interact with them directly. You might never even know they're there. But every time you place a trade and it fills instantly, thank a market maker. They're the invisible infrastructure keeping this whole system liquid. All right, so you understand what stocks are, how companies go public, how prices are set, and how market makers keep everything flowing. Most people just hit buy or sell without thinking about it. They use whatever the default setting is in their app. And honestly, for big liquid stocks, that's usually fine. But understanding your options gives you control. It's the difference between being a passive participant and actually managing your trades strategically. This is the simplest and most common order type. When you place a market order, you're basically saying, I want to buy or sell this stock right now. I'll pay whatever the current asking price is. When to use market orders. Scenario 1, you're buying liquid stocks. Scenario 2, you need to trade urgently. Scenario 3, you're a long-term investor. When not to use, illiquid stocks where the spread might be wide, pre-market or after hours when fewer traders mean worse prices, high volatility moments. Limit order, the my price or no deal approach. With a limit order, you set a specific price you're willing to pay or accept. Buy at X or better, or sell at Y or better. Only executes at your price or better, might not execute at all. Let's say a stock trading at $100 and you want to buy it cheaper. You place a limit buy order at $98. Now you're in the order book, sitting there with your bid at $98. You're waiting for the price to drop to your level. You own stock at $100. You set a limit sell at $105. It won't sell unless the price rises to $105 or higher. Protects you from selling too low, but you risk not selling at all if the price falls instead. When to use limit orders. Scenario 1, you have a specific price target. Scenario 2, illiquid stocks. Scenario 3, you're not in a rush. Stop loss order, the emergency exit trigger. A stop loss order is designed to protect you from big losses. You set a trigger price. If the stock drops to that price, your order automatically becomes a market order and sells immediately. How it works. You own stock at $100. Set stop loss at $90. Price drops to $90, triggers, sells at market. You might get $89.50 in a fast-moving market. The problem? Stop hunting. Big traders know where common stop losses are. Sometimes they push prices down to trigger them, buy the shares cheap, then the price rebounds. Controversial, but it happens. When to use stop loss orders. Scenario 1, you want downside protection without watching the screen. Scenario 2, you're trading momentum stocks. Trailing stop. This is my favorite order type for managing winning trades. A trailing stop is a stop loss that automatically moves up as the stock price rises. It locks in gains while still giving the stock room to run. You never have to do anything. The stop adjusts automatically as the price rises. It follows the stock up but never down. Different tools for different situations. The key is understanding what each one does and what it doesn't do. Because the wrong order type at the wrong time can turn a good trade into a frustrating loss.
So we've covered the mechanics, how prices are set, how orders work, who the players are. But here's the question that actually matters. What makes stock prices move? Like, why does a stock jump 10% one day and drop 8% the next? Why does it seem so random sometimes? The answer depends on your time horizon, because stocks move for completely different reasons depending on whether you're looking at days, months, or years. Short term, emotion and news. In the short run, the stock market is basically a popularity contest mixed with a panic attack. Prices swing wildly based on news, rumors, analyst opinions, and pure emotion. And I mean wildly. Logic often goes out the window. The market overreacted, as usual. If you're trying to trade on this time frame, you're competing against algorithms that process news in microseconds, institutional traders with more information than you, and the collective panic or euphoria of millions of investors. Good luck. Medium term, sector rotation. Zoom out a bit, weeks to months, and you start seeing patterns. The stock market isn't just random chaos. Money flows between different sectors of the economy based on where we are in the economic cycle. This is called sector rotation, and understanding it can help you make sense of why certain industries are hot while others are struggling.
Money flows between sectors based on the economic cycle. Early recovery. Tech and consumer discretionary lead. People are optimistic, they spend on wants. Mid-expansion. Industrials and materials lead. Economy growing, construction increasing. Late expansion. Energy and financials lead. Inflation rising, interest rates climbing. Recession. Healthcare and consumer staples lead. Defensive stocks. People still buy basics. This is medium-term price movement. Economic cycles, sector rotation, capital flowing to wherever the opportunity is right now. The illusion of simplicity. Here's what most people think happens when they buy a stock. You click buy on your app, the money leaves your account, the shares appear. Done. Right? Simple. Instant. Direct. Except that's not what's happening at all. Behind that simple button press, there's this incredibly complex machine running. Your order is being routed through multiple parties, fees are being collected, your trade is being executed across different venues, and money is changing hands in ways you never see. And here's the thing. Understanding what's actually happening matters, because every step of this process has costs, some visible, most hidden, and those costs add up. So, let's pull back the curtain. Let me show you what really happens in the milliseconds after you click buy. Your order journey. Step 1, you submit the order. Simple enough. Step 2, your broker routes it. Robinhood doesn't execute your trade themselves. They send it to a market maker like Citadel or an exchange like the NYSE. Takes milliseconds. Step 3, payment for order flow happens. Here's how commission-free really works. Citadel pays Robinhood about $0.002 per share for sending them your order. This is worth hundreds of millions of dollars to Robinhood annually. Citadel profits from the spread between the bid and the ask. Step 4, your order executes. You pay $50.15 per share. The market maker bought from the seller at $50.14, keeps the penny. Multiplied by millions of shares, that's their profit. Step 5, settlement happens in 2 days. The trade shows is filled instantly, but money and shares don't officially transfer for T+2, trade date plus 2 business days. You can trade immediately, but can't withdraw for 2 days. That's the journey. Quick, but not as simple as it seems. The hidden costs. Your trade went through. Feels free, right? Not quite. Cost 1, the spread. Cost 2, market impact. Cost 3, slippage. You want to buy at $100. You submit the order. By the time it executes, milliseconds later, price is $102.5. Slippage cost, 25 cents per share. Lit exchanges versus dark pools. Not all trades happen in one place. There are 2 parallel markets. Lit exchanges, the public market, NYSE, NASDAQ, all orders visible in the order book. Price discovery happens here, about 60% of volume. Transparent, regulated, public. After-hours trading. The market doesn't close at 4 p.m. It keeps going with extended hours. Pre-market, 4 a.m. to 9:30 a.m. After hours, 4 p.m. to 8 p.m. Why trade extended hours? Company reports earnings at 4:05 p.m. Numbers are terrible. You want out now, not tomorrow morning. Or you're an international investor in a different time zone. Unless you have a very specific reason, avoid after-hours trading. So, what is the stock market? Let me wrap this up. Mechanically, it's an auction system connecting buyers and sellers of ownership stakes in businesses. That's it. Functionally, it's the most effective wealth-building tool for regular people over long time horizons. Nothing else comes close. Emotionally, it's a test of patience, discipline, and rationality that most people fail. The game is simple. The psychology is hard. Practically, it's simple to execute. Buy index funds, hold forever. But it's psychologically difficult, watching losses, resisting FOMO, staying the course. The winning formula hasn't changed in 100 years. Start early. The earlier you start, the more time compounds. Invest consistently, monthly, regardless of what the market is doing. Diversify broadly. Don't put all your eggs in one basket. Minimize costs. Every percent in fees is a percent you don't keep. Ignore short-term noise. Daily news doesn't matter for 30-year goals. Never panic sell. The worst days are often followed by the best days. Hold for decades. Time in the market beats timing the market. The math guarantees wealth accumulation. The psychology makes it hard. Here's what you need to do right now. If this helped you, like this video. It helps other people find it. Subscribe for more honest finance education. Comment with your biggest takeaway or question. I read every single one. And, most importantly, take one action today. Open that brokerage account. Set up automatic transfers. Buy your first indexed fund. Don't just watch. Do. The best time to start investing was 10 years ago. The second best time is right now. Your future self will thank you. Let's build wealth together.